Welcome to the Deep Dive. Today we are tearing into the Q3 2025 results from Orla Mining.
And this was really the quarter where they had to prove it.
Prove what, exactly?
Well, that their whole strategic pivot, from being just a single asset operator to this diversified multi-asset growth platform, that it's actually working.
Right. And it was a challenging quarter for them operationally, but the market's reaction was, it was undeniable.
Oh, absolutely. The stock jumped nearly 14% right after the call.
So our takeaway is that management didn't just report good numbers. They used this record quarter to validate their resilience.
Exactly. And crucially, to confirm they can self-fund their entire growth pipeline. That's the big story.
That's our mission today, then. To unpack what drove that record performance, scrutinize the elevated costs that are still kind of looming, and analyze that complex regulatory chessboard that's going to dictate the future for their projects in Nevada and Mexico.
So let's start with the headline numbers. They dropped in on November 12th, and, well, they beat expectations pretty much across the board.
Okay, let's get into it. Profitability. Non-GAAP earnings per share came in at 22 cents.
Yeah, which was a massive beat, about 23% over the consensus target.
Which was closer to 18 cents. Why do you think the analysts missed by so much?
It was a mix of production optimization and, frankly, very high realized gold prices. Revenue hit almost $275 million.
Another beat, about 11% over consensus.
And that reflects a phenomenal 177% year-over-year increase, which is mostly driven by the full integration of the Musselwhite acquisition and, of course, the strong gold market this year.
But if we had to pick just one number, just one, that truly defines the change in this company, it has to be the cash generation.
Without a doubt. The company delivered a record $93.1 million in free cash flow.
And FCF, just for the listener, that's the cash left over after all your capital expenditures.
It is. And that $93 million translates to 28 cents per share. This figure is more than double the free cash flow from the same quarter last year.
That cash flow engine fundamentally changes their story, doesn't it?
It moves them from being a company that needs outside money to being their own bank for development. It's a huge shift.
And that FCF was built on the back of record gold production.
79,645 ounces sold at a very, very healthy average price of $3,417 an ounce.
Okay, let's turn to operations because the results look perfect, but the quarter itself was a bit fraught.
It was.
That mid-quarter issue at Camino Rojo, the pit wall movement in July. How'd they handle that?
So the pit wall instability, it forced a temporary mining pause. Management really stressed that their safety protocols worked. 0 injuries, 0 equipment damage.
That's the most important thing.
Of course. But the key operational takeaway was just how fast they responded. They avoided any real production losses by immediately pivoting to processing existing stockpiles.
And they started a fix right away.
Immediately. They initiated a big pushback plan to stabilize that north wall for good.
So mitigation is one thing, but that instability event, it still hit their bottom line. We have to talk about costs.
We do.
The consolidated all-in sustaining costs, the AISC, came in high.
They absolutely did. AISC, which, measures the full cost to produce an ounce of gold and keep the mine running, it hit $1,641 per ounce.
That is significantly elevated. It's above their own full-year guidance range.
Way above. Their range was $1,350 to $1,550.
So management is blaming the remediation at Camino Rojo and integration activities at Musselwhite. But how do we know this isn't just masking some structural inflation?
That is the central question for 2026, isn't it?
Are we just supposed to trust that 1641 is a one-off?
Well, management has signaled confidence that it's transitional, that the cost pressure should start trailing off in Q4. But, the market needs to see it. The key to getting costs down is really Musselwhite.
Speaking of Musselwhite, what's the latest there? It produced nearly 58,000 ounces this quarter.
A huge driver of that revenue growth. Management is focusing heavily on long-term efficiency there. They're investing in new underground equipment, and more importantly, the exploration program it's yielding fantastic results.
I saw some of those assays. They reported some high-grade extensions.
Really high grade. For example, 4.1 meters at 15.1 grams per ton gold, 1.6 kilometers along strike.
And for anyone listening who's not familiar with gold grades, 15 grams per ton is genuinely world-class. That's a game changer.
It really is. Their goal is to get into these deeper zones that trend between 6 and 7 grams per ton, which should, in the medium term, pull Musselwhite's own costs into that low $1,300 to $1,500 range.
Which would significantly help the consolidated cost picture.
Exactly.
So despite that Q3 cost overshoot, they reaffirmed their production guidance.
They did. Reaffirmed the 265 to 285,000 ounce range for 2025, and interestingly, they even signaled they're targeting the upper end of that range.
Which shows a lot of confidence that the Camino Rojo issues are contained and Q4 is going to be strong.
Right. Even if Q4 costs remain a bit transitional.
Okay, here's where it gets really interesting for the long-term story. The valuation is now all about advancing their two big development assets.
South Railroad in Nevada and the Camino Rojo underground in Mexico.
Let's start with Nevada.
Okay, so South Railroad hit a huge regulatory milestone in November. It transitioned to a FAST 41 covered project.
And for the listener, FAST T41 is a federal designation. It's specifically designed to streamline the environmental impact statement, the EIS process.
It imposes strict deadlines on government agencies. It's meant to de-risk that permitting timeline.
So what does that actually mean for first production? Does it speed things up?
Potentially. The final permit they need, the BLM Record of Decision, is targeted for Q2 2026. Construction would follow, so you're looking at first gold in early 2028.
But
management dropped a pretty strong hint that if FAST T41 works as intended, they think they could pull that first gold pour into late 2027.
And we should get more detail on that when they release their updated feasibility study in Q4 this year.
Correct. That study will detail a, quote, 2025 constructible plan. That's going to include a shift to owner-operated crushing and mining.
Which is all about enhancing gold recovery and de-risking the actual construction phase.
Precisely.
Okay, moving south to Mexico. The focus at Camino Rojo is all about expanding that high-grade Zone 22.
Yeah, they are drilling aggressively. They expanded their infill program to 20,000 meters to upgrade that polymetallic mineralization.
And those results are going to feed into a PEA, a preliminary economic assessment.
Which is the first formal technical and economic analysis of the project. We should see that sometime in 2026.
Now, the history of permitting big projects in Mexico has been, let's say, complex. But the chief sustainability officer sounded pretty bullish on the call.
He did. There were a couple of key positives. They renewed land occupation agreements. They got a new collective bargaining agreement. But the real leverage seems to be coming from the geopolitical level.
What do you mean?
There's a new Canada-Mexico action plan, and it seems to be helping their engagement with the federal authorities there.
An action plan to do what?
To advance responsible mining. The suggestion is that the permits they need for the pit expansion and the underground drift might move more quickly than they would have under previous administrations. Management sounded very confident.
So if operations are resilient, the costs are temporary, and the permitting is maybe even accelerating, what does this all mean for the shareholder?
It means the market is buying the story. The diversification, the self-funding capacity, that record free cash flow is the central pillar now.
Management was very explicit. They intend to use that cash to self-fund South Railroad construction.
Which reduces dilution risk.
And to accelerate debt repayment. They've already paid down $60 million ahead of schedule.
And with gold prices so high this year, the question of returning capital to shareholders is now front and center.
It has to be.
The balance sheet is strong, so the board is now actively debating initiating a dividend or some formal return of capital program.
That would be a huge development. It would signal Orla's graduation into a more mature mid-tier producer.
A major psychological shift for the investor base. It's the big carrot.
Right. But we do have to address the main tension point here. External analysis, while praising the quarter, did flag some lingering skepticism.
Skepticism about what?
About the exact timelines. For cost normalization and for the pace of that permitting at both projects.
And that's the crux of the debate for 2026. It's the tension between management's very optimistic outlook and the execution risk. It's an execution story now.
Okay, let's step into our segment where we look at a highly leveraged, outrageous, but plausible trade idea. And just to be clear, this is purely analytical and absolutely not financial advice.
Right. So we noted that massive surge in options volume after the earnings report, specifically in the December 2025 1750 calls.
That's deep out of the money.
Very. It indicates heavy speculative interest betting on a rapid near-term catalyst.
So we're going to lean into that. What's the pitch?
The pitch is this. You have the Q4 feasibility study for South Railroad right around the corner. You have aggressive drilling at Musselwhite with new assays expected early next year. The stock is primed for a shock on project news.
So the trade idea is a leveraged short-term bet, buying those December 2025 1750 calls.
The rationale is simple. We're betting that the upcoming feasibility study will formally announce that owner-operated plan and confirm the accelerated permitting timeline, pulling first gold into late 2027.
And if they can prove that de-risking,
It could trigger a sharp short squeeze coupled with that dividend anticipation that pushes the stock violently through $15 before the end of the year. That would make that 1750 strike very viable on pure catalyst speculation.
high risk, high reward. It's all based on management delivering aggressive, formalized project updates very, very soon.
To sum up, Orla has successfully used this powerful gold market and its recent acquisition to become a cash-generating machine. The focus now shifts completely to execution.
Proving they can build South Railroad on time and bring those elevated costs back into their target range.
That dense catalyst map, the South Railroad study, Musselwhite exploration, that looming dividend decision, it's going to define the entire trading narrative moving into the new year.
The market bought the growth story this quarter. That much is clear from the stock's reaction.
It did. So the question for you, the listener, is this. Will the dividend announcement, when it finally comes, be seen as the final reward for pulling off this pivot? Or will it be viewed as a distraction from the enduring execution challenges they still face in normalizing costs and navigating the permits in Mexico?
That is a great thought to mull over. Thank you for joining us for this deep dive into Orla Mining.
We'll be back soon with more critical analysis.